When lawmakers talk about taxing the richest Americans, the idea can sound simple. Set a line and tax everyone above it. But here's the catch. Where exactly is that line? Whether you want to tax income or wealth, the threshold you choose depends critically on how these concepts are measured. Are we measuring individual adults, tax units, or entire households? And are we counting only wages or also business income, retirement benefits, value of health insurance, and capital gains from selling assets? Those choices matter. For wealth, researchers generally agree on the basic definition: what a person owns minus what they owe. But the data sources tell different stories. One dataset might estimate the top 0.1% using individual adults. Another might use households. That alone can shift the cutoff by tens of millions of dollars. Realized capital gains are profits from assets when they're sold. For very high-income households, they can rise sharply in a booming market and fall just as quickly in a downturn. A threshold set in a high capital gains year might apply to far fewer households in the next year. The same is true when analysts use different datasets, definitions, or units of measurement. As we show in a new Washington Center for Equitable Growth report, the thresholds that are commonly considered by policymakers apply to very narrow slices of the population. For example, a $50 million wealth threshold reaches only about 180,000 households out of 130 million total in the US. At $250 million, the group shrinks to roughly 16,000 households. At $1 billion, we're talking about fewer than 1,200 people. These distinctions are not academic. They shape who a tax proposal reaches, how analysts model it, and how policymakers understand its impact. The takeaway is not that taxing extreme wealth is impossible. It's that defining extreme wealth is more complicated and important than it looks. Explore the full report at equitablegrowth.org.